This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we take a look at momentum for cruise lines in 2024.
Plus, the future of award shows may be at risk. But first, it was a real week of earnings with names like Netflix, Tesla, and IBM reporting. For more on the numbers from IBM, we spoke with Bloomberg Intelligence Senior Technology Analyst Anurag Rana.
One of the biggest things we talked about was the free cash flow number came out at 12 billion. I think we were slightly above the street and saying that, I'll be happy if they do 11 billion. So I think that really speaks both to the organic growth rate of the company, operational efficiencies, improving margins, taking care of accounts receivables, all sorts of things. So I think it's really good print for IBM in terms of free cash flow, but also the guidance on the organic growth rate, because we were going in. So in fourth quarter, they did 3% growth rate in constant currency. We thought at least for the first few quarters they're going to talk about 3 to 4% and then accelerate. But they straight away went with a mid-single digit number. So I think overall good for IBM, good for the rest of the tech space. I feel pretty happy about it.
I know this is kind of probably a dumb question, but what in IBM's business model to a Luddite like me are they doing well? Break down the different categories in a way that makes sense to Alex.
So they still are a very big piece of the entire tech ecosystem. They have very strong relationships. They have a good consulting business. They have Red Hat. They sell mainframes. Now, remember one thing. I know people getting very excited, but if software spending is climbing between 10 to 12%, IBM's still growing, 6 to 7. So they're still underperforming the entire broader software space. But that's okay because, when you go from 3 to 6, that's a big change also in terms of the growth rates. This is just a matter of overall tech spending improving after 2 years of underinvestment. This is something that we have been saying for so long. Tech as a portion of total GDP is a very small number. Most of the companies around the world, barring the consumer technology companies that we see, have underinvested in technology. So when you have rail companies or airlines or auto insurance companies, they really need to be more digital. And one way to get digital is to move a lot of their infrastructure to the cloud. So all of those things play in well. We have not seen good spending in 2 years. I'm pretty happy that 2024 we may see a rebound.
How does IBM fit into the AI discussion? Because I know the CEO called out the client demand for AI is accelerating. How do they play in that space?
So majority of the stuff that they're going to do is on the consulting side. So if you are a large company, you need to figure out what to do. They have a lot of consultants that can help you clean up the data, use whichever model we want to use. You want to use something from OpenAI, Anthropic, all these companies that are out there, they'll help you with that, help you train the models, and then at the end of the day, you make it for your business case. It's not as easy as just, using ChatGPT and answering questions. For an enterprise use, you need to do a lot of data cleanup, data aggregation, because that's what's needed to clean up your, the models itself.
How fast and long can that kind of growth rate of 6-7% go?
I think if this year they are able to go to 6-7%, I could expect then, another 100 to 200 basis points improvement next year. And that's actually not a bad deal because you remember the old IBM just about 4 or 5 years ago, they were not growing at all. So in order for them to actually come up with a high single digit number next year would be really welcomed by the market.
So what's the read through here, Anurag, for greater tech here from IBM? I'm just going to go out and start buying more of these names? I'm looking at NVIDIA, for example, up 25% year to date, and of course up 220% over the trailing 12 months. I guess this is a pretty good read through. Can I do that?
Yeah. So we had run a CIO survey back in December, and we kind of got the indication that it's going to be a year of spending more aggressively compared to the last two in 2024. But, the way we had built that, and, we got the chip strength going on right now that probably carries on till the summer. And then after that, we see, strength in the software and the consulting area, which are more of the downstream play. But it's possible that we may see that bounce back, as early as second quarter or, going into it, because things, I think the leading indicators are good at this point. So I'm pretty optimistic that, when we were thinking about a second half recovery for tech spending, it may actually happen in second quarter or maybe even as late as first quarter.
Our thanks to Bloomberg Intelligence Senior Technology Analyst Anurag Rana.
Let's turn now to airlines, where names like American, Southwest, and Alaska Air surprised analysts by beating expectations. For more, we spoke with Bloomberg Intelligence Senior Defense and Airlines Analyst George Ferguson.
We got American, Alaska, and Southwest. Yields were down in the domestic business on all three. Alaska yields were down 6 or 7%. American yields down similar number. Southwest really just let load factor fade away into the 70s and took a yield down sort of 2%. So to me, they're guiding to better results as next year as we get into 1Q doesn't look great, but as we get past 1Q, the overall guidance for the year looks a bit better. So airlines, I think things are going to firm as they get into next year, but I don't think it looks like a healthy market at all from the numbers I'm seeing in Q4.
So give us a sense of where we are just in terms of air travel. Have we established a new post-pandemic normality in terms of where leisure traffic is and where business traffic is? Do we kind of know how that market looks?
So comments from United were that business traffic wasn't back to 2019 levels. They said they saw hopeful signs in 1Q. So business hasn't come back fully. Is this the new normal? I would guess it is, right? Because we're I don't know when the pandemic actually sort of ended, but we're probably a year and a half past. And I would expect most of, normality to have returned to our lives. So it seems like we still have some level of deficit on pre-pandemic business travel, but leisure travel has definitely exceeded that. I think the airlines have just sold the capacity they would have sold to the businesses into the leisure side. And I think that's making the fares softer.
So you say that the quarter didn't look that great, first quarter looks soft. I get that. But then you said that after Q1, things start to look a little better. What's going to look a little better? Is it business travel? Is it we just keep doing vacation stuff? We do it domestically rather than internationally? Or is it still across the board?
I said that after Q1, the airlines think it's going to look better. I don't see it, right? I think the big leisure bounce back was last year, 2023. And I think that you could see softer domestic yields all through the year. But, we had Scott Kirby at United Airlines earning earlier in the week, and he's telling us how, he's getting traction from premium products, and that's going to help him drive better profitability through next year. I mean, companies like Alaska, they have premium product, but I think they're roughly the same amount, unlike United that's adding it. Southwest has no premium product. So there's a lot of other airlines that have no premium product, and I think they're going to be fighting for the base leisure traveler. I think it's going to be difficult. But
George,
again, it's the airlines that they see it coming. Sorry.
George, you're out in Los Angeles, the Aerospace Supply Chain Conference. How is the supply chain for the airline industry? Can they get the planes they need?
That's rough. So we saw the news on Boeing about not allowing them to increase. The discussion at the Aerospace Supplier Conference is all about labor, and labor.
Wow.
There's been a lot of turnover. There's a lot of turnover in the industry. The backfill needs to be trained. They're not fully trained. They're not efficient. And there's still people having a hard time finding labor. Mm-hmm. And so the U.S. aerospace industry is in pretty tough straits, I think. I think young kids, a lot of the discussion here is that young kids, young professionals don't want to come to this industry. They'd rather work for Amazon. They'd rather work for Google than go to work in the aerospace industry. And so they're having a real hard time backfilling and training and keeping people in the industry.
So to that point, what happens if Boeing isn't allowed to produce the plane that the FAA said? I can't even keep track to be honest with you, but if they can't produce it, what happens to those that have ordered it?
I mean, right now, what the FAA said is that Boeing can't increase production, right?
Okay,
so
increase
of the merits. They're already building. They were building about 31 a month last year. They were supposed to rate break to about 38 a month at the end of the year. The question is, have they? So will the FAA let them continue at 38? And then as I understand it, the FAA is going to inspect their manufacturing processes because they're quite concerned, obviously, after the Alaska incident, to make sure it's stable, make sure that Boeing can build aircraft safely. So my guess is you got something that's going to last part of this quarter. I mean, there's only so many sites they can really inspect, right? You've got a lot of inspection down in Wichita, a lot of inspection up in Renton, Washington. Those are the two main factories. The FAA could go deeper and do some of the other suppliers, which they probably will, but there's not a lot of sites to inspect. My guess is that deliveries for customers that expected airplanes in 2024 could get pushed out, probably will get pushed out maybe into 2025. Could be customers, core customers like United, Southwest, Ryanair, Alaska Airlines. They've been taking the majority of the orders recently. So you'll hear some howling from them. I think you already heard some howling from United CEO Kirby, right, on the MAX 10. So I think that's what's going to happen. You'll just see deliveries get pushed out and pushed into next year. Hopefully Boeing can recover that and bounce to higher rates. That's all about their recovery.
I mean, I just kind of feel like they're kind of too big to fail. They're too big for anybody to really do anything because it's a duopoly, them and Airbus. But what is it like a downside scenario here for Fox? Would it be government regulation? Would it be what's kind of spooking the market?
Well, I think you already have part of that downside, right? And that's more intense government oversight and regulation. Frankly, that probably should have occurred anyways. You know, the FAA is also going through some difficult times during the pandemic, lost a bunch of personnel. They need their skill sets developed, sharpened. So this process could be slow. But I do think I think they are close to too big to fail, given that they're such an important government contractor. One of the few big primes that can make airplanes in serial production. Mm-hmm. The question is, what could the government do if they had real big problems on the commercial side? I don't think we're there yet, though. I think it still is a duopoly. If you wanted to get in the back of the line for an Airbus A320, the competitor right now, if we just add up all the orders they have and their production increases, you're out 8 years. And I think some of those orders are definitely long-dated orders. So maybe if you got in the back of that line, you'd be out 5 or 6 years before you started getting airplanes. That alone is going to keep folks going towards Boeing for airplanes. Yeah. But that's only if things don't degrade from here. If things degrade from here, you got a much bigger problem.
Thanks to Bloomberg Intelligence Senior Defense and Airlines Analyst George Ferguson.
All right, coming up on the program, Baker Hughes breaks free from rivals with a lower shale view this year. We speak to the CEO.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Conflict in the Middle East and uncertainty in the global economy have the energy sector facing a lot of unknowns.
Baker Hughes, the world's #3 oil field contractor by market value, is also feeling the pressure. This week, the firm announced earnings that were below expectations, and analysts are raising concerns.
All right, to take us through how Baker Hughes plans to manage all of the risks facing oil, we spoke to Lorenzo Simonelli, Chairman, President, and CEO at Baker Hughes.
First of all, we're coming off some great results in 2023, and also we've laid out a clear strategy as Baker Hughes over the coming years. As you look at 2024, we've given a guidance that is a balanced approach with all of the geopolitical and also uncertainty that's happening around the globe. So we stick to our guidance, and we think that we're executing. And as you look at the guidance, we've got considerable growth in 2024 and great performance as well.
So if you're more conservative than your peers, where is the question mark? Is it going to be the new energy orders? Is it going to be onshore demand, or is it going to be offshore? Is it domestic or international that has you thinking and questioning the most?
You look at what's happening around the world and you see the geopolitics, you see what's happening from the OPEC cuts, you see what's happening from the consolidation in North America. And that leads some uncertainty relative to the activity levels within North America land. We still see that U.S. North America should be flattish, but U.S. land will likely be negative for the year, given some of the consolidation and also some of the activity. International, again, will be in the high single digits, so we still see that being robust. And I think, again, as we look at giving guidance, we're taking a balanced approach to what's taking place around the world at this moment, and also giving a predictability to our investors on what can be achieved and also confidence in what we can achieve.
Lorenzo, I just looking at your business here, and I see that about 3/4 of your revenue comes from outside of the United States. So obviously you are attuned as much as anyone to the geopolitical risks around the world. What are you telling your investors about, what's happening in Eastern Europe, what's happening in the Middle East, and how that may impact your business?
We're telling them that we've taken every caution, and also we're managing the situation. We haven't seen any impact, and we don't anticipate a big impact, but we do think some of the development plans may be delayed slightly over the long term. No change in what the NOCs and also large customers are laying out from a capital spend, but there may be some, I would say, delays. Again, as we look at the outlook internationally, we're still anticipating high single-digit growth, and we think that international is a key place for us to be, and we look to perform there over the coming years.
Lorenzo, what's your take on the demand side?
Well, Alex, it's always difficult to predict some of these elements, just like it is oil price, and you know this space well. I think demand continues to be robust. A lot of it's going to depend on the economic situation as you look at some of the events unfolding also globally. And we anticipate that, again, demand will increase this year but continue to be strong, especially in the developing world.
What are your customers telling you here? I know you obviously close contact with them. What are they telling you about their spending plans over the next couple of years?
Again, it varies. You've seen in North America, obviously, some consolidation. So people are going through that consolidation, and they'll be looking to adjust some of their spending plans in the short term. But again, continuing to be robust on the long term as you continue to see the demand be there. On the international side, these NOCs have multi-year projects that they're executing. There'll be some variation in the timing of those, but again, the long term continues to be solid. And as you look at our guidance, again, we're anticipating that maybe there's some tempered view on some of the pace of the developments, but the developments are going to happen.
NOC, Paul, just National Oil Company.
Thank you.
Just I'm hooking Paul up with the oil jargon there. Lorenzo, you mentioned the M&A situation, and I find that so interesting because that was one of my questions to all these CEOs when they announce these big mergers is, are you actually going to be slowing your oil production growth over time? And they're all like, no. It's going to be really good. It's going to keep growing. What do you think that timeline actually looks like? In the beginning, there's synergies, they get more out of the ground, but then that tapers off. What do you notice?
So as you look at the normal evolution of consolidation, we've seen this cycle before. You are going to continue to see production increases, but you're also going to see synergies between the consolidation. And as they go through their integration activities, I think you'll likely see some tempered measures relative to some of their procurement. But again, production, they're going to seize the opportunity to continue to increase production as the demand is there.
I'm not an expert in this, unlike Alex, but a term I used to hear a lot, and I don't hear it that much anymore, is peak oil. When are we going to be at peak oil? Are we at peak oil? I don't hear that discussion anymore. So when you're talking to investors, how do you talk to them about the long-term kind of demand for oil?
You've got to look at it from a standpoint of the energy transition is going to be multi-decades, and it's going to require an energy mix that is abundant of providing as clean as possible fuel sources to the public. And that means oil is going to have a role to play. And we see oil and gas in particular having a strong, robust outlook as we go forward. And the question on peak oil has been asked many times. There will be a time when peak oil comes. I think it's not at this stage. And we continue to focus very much on gas and also LNG.
Lorenzo, somehow restricting LNG exports in the U.S. is becoming something people are talking about. The permit process has gotten a lot slower. What is going on?
Alex, it has gotten slower. And again, we're monitoring the situation. And I'm disappointed because as you look at the benefits of US LNG, not only for the US, but also for the world, and also what's been achieved with the geopolitical uncertainty and also providing to Europe, there's been commitments that have been made. And we should continue the US LNG exports and also the permitting of these projects. That being said, international projects are continuing to move forward. And we have an expectation that, again, in 2024, there'll be 65 MTPA FID'd, and we're again seeing about 30 to 60 MTPA FID'd in 25 and 26. And by 2030, there'll be a global capacity in place of 800 MTPA. So, we'll monitor the US situation. It's disappointing. I think it will sort itself out. There's been a lot of commitments that have been made to international partners.
Lorenzo, I really appreciate that, the conservative approach, and then sort of moving a lot faster in the next couple of years. Thanks a lot. I look forward to seeing you next week in Florence, Italy. Thank you. Lorenzo Simonelli, he's chairman, CEO, and president of Baker Hughes. Now we're going to do something that only Paul and I can do. Talk to a CEO, then bring a Bloomberg Intelligence analyst who's been covering the company for years on to then talk about it. This is what we can offer you on the Bloomberg Intelligence show every day. Scott Levine, he covers oil services for Bloomberg Intelligence. What did you make of the numbers and just talking with Lorenzo in the last 10 minutes?
Frankly, the guidance that Baker gave for mid-teens EBITDA growth is almost identical to what SLB gave. I think the difference here is probably the conservatism around the messaging, number one. Certainly the low to mid single digit decline that they're calling for spending growth in North America, high single digit growth in international trails what we saw out of both of those two companies. And then secondarily, LNG, as you mentioned, is a really big driver for Baker. That's unique to them, certainly much more so for them as a producer of modules for LNG plants, which neither SLB and HAL do. And I would say that the commentary there was maybe a little bit more downbeat as well. They're looking for modest growth in FID capacity this year. They focused more on some of the businesses outside of that. So I think it's probably more so the tone out of Baker being a bit more sober than the guidance per se, which was in line with consensus and the growth outlook similar to what we saw out of the peers there.
So I'm looking at the ANR function for Baker Hughes, Halliburton, all the comps. The street likes this stuff. They like these oil services companies. What's the bull call on this? Is this people going to need oil forever?
Yeah, well, they are investing in the future with the energy transition and the new energy business as well. But I think, so look, 2 years ago, 2022, this group was outstanding, right? The group was up 60%, the market was down close to 20%. Last year, the group performed okay in a much stronger market, and the growth expectations for the group have moderated and are moderating still in 2024. I think within that context, folks are still comfortable with large cap, globally diversified oil field service companies like Baker Hughes, like SLB, to a lesser extent Halliburton, because they're more focused on North America. But they're still comfortable with these companies. They're large, they're global, the balance sheets are in good shape, they're returning more than 50% of the free cash to investors. And so that appeals to investors that kind of are attuned to this new energy environment where it's disciplined growth and capital returns rather than the wildcatter mentality. So I think
that's what I like. I like the wildcatter.
Yeah, he likes that. I called SLB Schlumberger. I'm definitely going to hear from them later, but SLB. So to that point, though, I feel like if you talk to SLB, they'll talk a lot about digitalization and all that kind of stuff, whereas Baker Hughes talks really about LNG, and they build these big terminals. They help to do that, like with the likes of Bechtel, for example. Yeah. Do you feel like at some point these guys are going to be, you can really bet on them in different ways? Like, I'm going to bet on Baker Hughes for LNG. I'm going to bet on SLB for an AI component and digitalization. Like, can I do that yet?
You can, and I think those are accurate depictions of the business, but I wouldn't overstate their significance. Like, I feel like Halliburton gets maligned a lot for the North American exposure. And
they do have some solid international.
It's over half their business.
I totally didn't know that until your note the other day.
But SLB is 80% international, and these guys are closer to SLB than they are to Hal in terms of that geographic split. So, while the statement is true, I think it's equal parts branding and as it is the business mix, and investors are naturally going to look for ways to differentiate between the companies, and so they'll gravitate towards the differences more than they will the similarities. But I think there are a lot of similarities in the balance sheet. All the companies are focused on global markets to more or lesser extent, and so with Baker, the LNG emphasis is a differentiator for sure. They have a much bigger equipment business than either SLB or Halliburton does, and so it's natural for folks to focus on that specifically, and some of the weakness in demand out of Europe maybe is weighing on that story a little bit, but it's still a very strong business for them.
That's Bloomberg Intelligence Senior Industrial Services Analyst Scott Levine talking outlook for oil, following up on our conversation with Baker Hughes Chairman, President, and CEO Lorenzo Simonelli.
Coming up on the program, we're going to get the outlook on the cruise industry and our award shows fading from the spotlight.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Royal Caribbean's Icon of the Seas embarks on its first official voyage this weekend, and the journey is sure to make waves.
Oh, nice one. Bloomberg Intelligence Senior Credit Analyst Jody Lurie covers the leisure sector, and we spoke with her about her sneak peek at the world's largest cruise ship, as well as what to expect from the cruising business in 2024.
So when you think of a cruise, it's your standard cruise is you have just rooms on the outside, right? The balcony rooms that you can see the oceans. Then you have the internal rooms with no windows. And so you just have 2 rows of those sets. And then you have a bunch of floors that have things like dining hall experiences that are main big dining room. Then you have shows, right?
So this is Royal Caribbean owns Icon of the Seas, right?
So Royal Caribbean owns Icon of the Seas.
Talk to us about the cruise business. You covered from the credit side for Bloomberg Intelligence. Are these good credits?
These credits have been a very interesting set to cover. You think about the pandemic, and they were sort of written off for dead.
Yep.
Now they've had this massive turnaround. The momentum around them has been pretty palpable. And I think the Icon of the Seas, the reason why it's so important is that the narrative around it speaks to this rebirth in the cruise market that we've been seeing. These companies have been generating cash flow. They've been repaying debt. They've been setting their sights on investment grade and have been targeting it as much as they can. They're really trying to bring down their debt loads. I mean, you're talking Carnival's $36 billion, now down to $30 billion, and it's going farther down. And
so I appreciate that Paul wants to make this about finance and stuff, because that's what we do. But I want to go back to what it looks like. So, okay, so you laid out sort of what cruise ships normally are, right? So then why is Icon of the Seas different? And I'm asking really because that's where the money's going to come from to then pay down debt. So like it's kind of a market question.
It is definitely a market question. So it's the why are people going to be willing to be one of the 7,600 people on the ship in addition to the 2,400 of crew? Well, they have things like 6 water slides.
Nice.
They have ginormous areas for children, as well as, of course, the kids club for you to just check your kids in and leave them there for the whole day. They have different specialty restaurants where they try to rival something like a Las Vegas casino. The feel of it, the look of it, if you look at it at night, which I got to see it the night before I drove by it, it looks like it's lit up like you're Vegas. It's like Vegas on water. And I think that's what they're trying to compete with. And I do know for a fact that, we actually got to sit down with management a month ago at the Celebrity Ascent naming. And they
Celebrity Ascent naming? What now?
So, what is that? Oh
Celebrity Ascent. So Celebrity is one of Royal Caribbean's cruise lines, right? So they have Celebrity and they have Royal Caribbean.
Okay.
The Ascent is their newest ship. It's one of their Edge class series. And they had a naming, so all ships have this big naming ceremony where they break the bottle of champagne. They have a godmother or godfather of the ship, and they have this whole big ceremony, and it's a big party. So they invited us finance folks on there as well, and we got to sit down with management, and it was before they were in their quiet period. They basically told us that they don't see the other cruise lines as competition. What they see as competition is on land. vacations.
Oh, that's interesting.
So your casinos, your theme parks, that's where they see them taking share, or that's where they see people convincing people to go elsewhere, not to the hotels and the casinos and the theme parks, but on the cruise ship entirely.
What are the cruise companies telling you about business? Is revenge travel over? How's business in 24?
So more so than what management is saying, we actually ran a survey that we did the results. Quite a substantial number of people want to travel and want to spend more when they travel this year. So even though revenge travel, as they call it, post-pandemic revenge travel, that's the people who are cooped up inside, want to go places, don't care how much they spend, even though that might be fading, and a lot of companies have indicated that, at the same time, the conversation around people spending on experiences is still very much there. Whether that holds up into the end of the year as we see what the Fed does, as we see all the different sort of economic points and pain points come out, I think it remains to be seen, but we are seeing that people are prioritizing experiences over stuff, and they continue to do so. And the way that the cruise lines benefit is that they get to encourage people to spend on onboard spending. So all the add-on features.
Oh.
So you go to their perfect day at Coco Cay Island. Guess what? You want a cabana, another $1,500, $2,000 for the day.
Oh boy! All right. For speaking of this research, you can just get Jody Lurie's bio if you're sitting in front of a terminal, and you can put her bio up there, and it lists all her research. And this is the top research notice published today. Focus on cruising in 2024 BI survey. So check that out.
I'm still astounded.
Well, here's the thing. We went down to Aruba. We went to a resort.
Yes.
They give you the little bracelet.
Yeah.
Oh, man. That's your key to your room. You want to buy anything, you just go bing, bing. I mean, wow, they make it so easy.
And you don't know
to
you're
spend
doing
money.
it. And all of a sudden you're paying, you're like, wait, what? This was all
That's
inclusive.
why this year we went to an all-inclusive.
Yeah.
Oh, that was the way to go.
But aren't there also add-ins for all-inclusives too?
No.
Like all-inclusive, but this super fancy restaurant isn't included?
No, I mean, if you want to buy like a bottle of wine, that was extra. But I should have done that when I had 4 kids. Because you check out every resort and your bill is like 50 pages.
I mean, we're seeing that Marriott, we're seeing Four Seasons, they're going into the smaller vessel ships. We're seeing that people who used to like Crystal, which was the high end, and it went through a little bit of a restructuring, just a little bit, that people are then going over to these higher end ships. And they are also going to the Norwegian higher end lines. So Norwegian has a few higher end lines. Carnival has a few higher end lines. So people are moving to there from these other ships because they are smaller vessel. They are much more manageable. You're viewing it both as a way to lounge, but as a way to get to Aruba or
what I
wherever.
feel like this reminds me of is what people are doing with airlines, right? No one wants basic economy. They all want to trade up. So everyone goes to business class, and then all the people who normally fly business class are like, get me out of here. And they go to first class or they go to private. Like, I feel like it's just sort of the up tier at the end of the day.
A la carte, everything. So
everybody wants to feel like a VIP. That's
Wait, we're not VIPs?
I know, that's the model. I mean, you look at all the rooms. I mean, they have the suite room, and they have this suite room, and the presidential suite, and then this suite, and then that suite. And that's all designed to make everybody feel special and feel like they're a VIP. And also to make it Instagrammable, because that's the age we're in.
Jody was posting on social, and she had a lovely room with a lovely view. That was pretty cool.
It was a great view. I mean, any view of the water is a great view.
So just to end for a moment on finance stuff, would you like any of these credits? Like, what's your favorite play?
So I do think that the cruise lines in general still have some room to run as compared to other parts of leisure. I think that other parts of leisure, it's really more of a company by company story. So something like a SeaWorld has been repaying debt. They've been restructuring their capital structure, and it's been very positive for them in that sense. But from a momentum in terms of travel, that top line isn't necessarily going to grow as much. We're still seeing that the cruise lines are benefiting from that booking. Similarly, we're seeing a mixed result in the hotel space. So you have the Marriotts of the world, you have the Hiltons of the world. Those companies have been improving from a growth standpoint and have been focusing on other parts of the market. But you have something like a Choice that's in a hostile takeover with Wyndham. And so that kind of throws it out the water, and you say, okay, we don't really know what we're going to do with this, but this is a company that is not necessarily in good standing from a credit quality standpoint.
That was Bloomberg Intelligence Senior Credit Analyst Jody Lurie.
Let's turn now to entertainment, where waning audience numbers are causing big concern for award shows like the Oscars.
We spoke with Bloomberg Opinion columnist Bobby Ghosh about why viewers are less inclined to watch a 3.5-hour TV extravaganza.
So, all the award shows, Oscars, Emmys, Golden Globes, the audiences have been dropping precipitously over the past decade. It used to be that an Oscar night would be 40 million viewers, and then it became about 30s. Now it's down to, if they get 10, 12, then they're lucky. Last year there was a little bit of an uptick. I think a lot of people sort of basically dialed in to see if there'd be a repeat of Will Smith's slap on Chris Rock. There wasn't a slap. This year, ironically, the nominations are going to get a lot of buzz for the reasons we've just been talking about. Because Margot Robbie gets snubbed, because Greta Gerwig gets snubbed, there'll be a lot of buzz around the nominations. But for those exact same reasons, I suspect fewer people will watch the actual Oscars. It's too long. It's, there's just too much sort of pomp and circumstance and very little actual content, and most people will consume the highlights on YouTube and on TikTok. On
that's not what the ABC television network wants to hear. Because that's historically these events, which the former CEO of CBS would call wow events. That's what brings in huge advertising dollars. So that's just another emblematic of the overall issue of TV cord cutting and so on.
Yeah, they'll sell out the ads. They sold out the ads last year as well, but at a lower rate. So that's something that they need to worry about. If they'll, sufficient numbers of people will tune in, that advertisers will still remain interested in the event, but for progressively or smaller and smaller amounts of money.
And here goes this. This is the sales pitch that broadcast and cable television have been making to Madison Avenue for 30 years.
Yeah.
Okay, here's the pitch.
I'm ready.
I'm going to give you an inferior product to what I gave you last year. I'm going to charge you more.
That's not going this way anymore.
And it works every single year.
Wait, so they're charging more for this space right now?
Every year, up until the last couple of years when cord cutting became so bad. But broadcast and cable television would say, I know my ratings are down because there's 500 more channels. But still, I have the biggest audience at CBS. Yes, it's half of what it was 10 years ago, but it's still bigger than anything else out there. Oh, by the way, for that, I'm going to charge you another 5, 6, 7, 8%. And that worked forever. Now the issue is...
Yeah, I don't think that can be sustained for very much
longer.
We'll see.
I don't know.
Yeah, I think, again,
unless you're the Super Bowl. If you're the Super Bowl, you can go out and
sports is a different category.
Yeah.
But, sports... If you're a fan, you don't want to just watch the highlights. You want to watch the live performance. But with Oscars... With any award show, more and more people are quite happy just to see the highlights immediately after the award is announced. They don't want to watch the whole
awkward moments.
The awkward moments, the songs, the skits. It seems like too much of a muchness.
That used to be must-watch.
It really, I know.
It goes to John Tucker's. The whole world's coming to an end.
Well, I would have Oscar parties. Literally, we'd do boats. We'd put in money. People walk home with a couple $100. Like it was like.
Can you bet on the? I guess you can.
With people in my home, sure. I mean, in the reality of the world.
Maybe I might be into it then.
Maybe. But what I also wonder too is, do you think that these kind of live events will go the way of sports in different ways of viewing it? Like we saw WWE and Netflix, for example. Yeah. Like, would Paramount be like, hey, let's just air it streaming and save some, is that a thing?
Well, I think you'll probably, if the audience continues to shrink, they'll have to find new ways of making it relevant. In time, I think you'll see the duration of it shrink. I don't think a 3.5-hour program, which invariably goes closer to 4 hours, I don't think that's sustainable anymore. This year, they're bringing it forward. They're starting broadcast an hour early because they're conscious that in that last hour, past bedtime in the East Coast, a lot of people, the next day is a school day, lots of people just switch off. And that's a real problem for them. So they're bringing it forward to try and see if they can sort of juice the audience that way. I think you'll probably see certain amount of stunt casting in the people who are hosts or presenters. We've seen that happen in the Olympics, for instance. Olympic audiences have been down. NBC has been bringing in people like Snoop Dogg to try and get audiences interested. I say, okay, let's have a switch and get some Olympic performers to present the Oscars. I'll watch Simone Biles.
Well, ABC doesn't have the rights.
Totally
ABC doesn't have the rights to the Olympics, so you're not.
That's true, but you can bring an athlete in. So
exactly. Well, that's a good thing. I mean, you're bringing in athletes to just some stunt hosting. I
think you'll see progressively more and more desperate attempts to try and hold on to that audience, but I think that ship has sailed.
Our thanks to Bloomberg Opinion columnist Bobby Ghosh.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney.
And this is Bloomberg.